Now, if you told me you owned all of the Bitcoin in the world and you offered it to me for $25, I wouldn't take it, because what would I do with it? I have to sell it back to you one way or another. I mean, maybe I have the same people, but it isn't going to do anything. The apartments are going to produce rental, and the farms are going to produce food. And if I've got all the Bitcoin, I'm back where whatever his name was, who may or may not have existed, was 15 years ago. If I've got it all, he could create a mystery about it. But everybody knows what I'm like. I mean, so if I'm trying to get rid of it, people will say, well, why should I buy some Bitcoin from?
Hey there. Today, I'll delve into the fascinating debate surrounding Warren Buffett's stance on cryptocurrencies, particularly Bitcoin. Let's explore the reasons behind Warren Buffett's reluctance to support Bitcoin and delve into his perspective, which challenges the growing enthusiasm for cryptocurrencies in finance. CNBC states, Bitcoin has steadily been gaining acceptance from the traditional finance and investment world in recent years, but Warren Buffett is sticking to his skeptical stance on the cryptocurrency. Warren Buffett said, "Whether it goes up or down in the next year or 5 or 10 years, I don't know. But the one thing I'm pretty sure of is that it doesn't produce anything." Warren Buffett's continued skepticism about Bitcoin is evident in his recent statement, where he emphasizes his doubts about the cryptocurrency's long-term prospects. Despite the growing acceptance of Bitcoin within traditional finance and investment circles, Buffett maintains his cautious stance. His remark that Bitcoin doesn't produce anything reflects his belief that productive assets with intrinsic value, like businesses or real estate, are a more reliable foundation for investment. While he acknowledges the volatility of Bitcoin's price, he remains uncertain about its ability to generate accurate, sustainable value over time. His unwavering commitment to his investment philosophy underscores his consistency as an investor and his tendency to favor assets with tangible, income-generating qualities. As the cryptocurrency landscape continues to evolve, Buffett's perspective adds an exciting dimension to the ongoing debates surrounding digital currencies. Furthermore, he questions Bitcoin's utility when juxtaposed with physical assets like apartments and farms, which generate genuine value through their productive capabilities. Buffett's central argument revolves around the absence of intrinsic value in Bitcoin, distinguishing it from income-generating assets like businesses or real estate. He humorously suggests renaming it Buffett coin if someone were to acquire all of it, emphasizing his belief that cryptocurrencies lack substance. Ultimately, Buffett's feedback reflects his cautious stance on Bitcoin, considering it a speculative investment rather than a reliable store of value or wealth-building asset. Warren Buffett said, "When it comes to cryptocurrencies in general, I can say almost with certainty that they will have a bad ending." That's right, it's ingenious and blockchain is important, but Bitcoin has no unique value. It doesn't produce anything. You stare at it all day and no little Bitcoins come out. It's a delusion. Now let's break down Warren Buffett's reasons for his stance on Bitcoin into 2 key points.
There's all kinds of frictional costs that are very real that somebody has paid to a bunch of people who facilitate this game. But whatever one group of the public has taken out, or one group of owners, has come in from other people. It's other people have entered the room and they move money around, but there's no more money in the room. It just changed hands with a lot of maybe fraud and costs involved and, a whole bunch of things you lose, you forget the numbers or forget the equation. You can do that with a lot of things.
First key point, risk of fraud. Warren Buffett highlights a significant concern regarding the potential for fraud within the cryptocurrency space. This concern is based on several factors. 1. Decentralization. Cryptocurrencies, including Bitcoin, operate on decentralized networks. This means that any central authority, such as a government or a financial institution, cannot control them. While decentralization offers benefits like increased security and autonomy, it also creates challenges regarding oversight and regulation. Without a central authority, monitoring and regulating the activities within the cryptocurrency ecosystem becomes more challenging. 2. Pseudonymity. Cryptocurrency transactions are often pseudonymous, meaning users are identified by wallet addresses rather than personal information. While this pseudonymity can provide privacy, it also opens the door for dishonest actors to operate under the radar. Fraudsters can create anonymous wallets and engage in illicit activities without revealing their true identities. 3. Fraudulent activities. Due to cryptocurrency's decentralized and pseudonymous nature, dishonest individuals and groups find it easier to conduct fraudulent activities. This can include Ponzi schemes, where investors are promised high returns but are paid with the investments of new participants, leading to financial losses for later investors. Phishing scams are another concern involving fraudulent websites or emails that trick individuals into revealing their private keys or wallet information, resulting in the theft of their cryptocurrency holdings. 4. Lack of regulatory protection. Traditional financial markets are subject to regulatory oversight, with authorities like the Securities and Exchange Commission, SEC, in the United States protecting against fraudulent activities. However, the cryptocurrency space is still relatively nascent and lacks comprehensive regulatory frameworks in many jurisdictions. This absence of regulation leaves investors with limited recourse if they fall victim to fraud or scams. Warren Buffett's concern about cryptocurrency fraud arises from its unique traits, decentralization, and pseudonymity that facilitate fraudulent actions, risking financial harm to unsuspecting investors. Additionally, the absence of strong regulations underscores the importance of enhancing investor knowledge and awareness in this rapidly changing financial arena.
When you buy a farm, you look at the crop every year and what prices are, and you decide whether it was a satisfactory investment. I mean, you look to the asset itself and what it produces for you. When we buy a business, we look at what the business earns and decide how we feel about it in terms of what we paid. But we are buying something that at the end of the period, we not only have what we bought in the first place, but we have something that the asset produced. And when you buy non-productive assets, all you're counting on is whether the next person is going to pay you more because they're even more excited about another next person coming along. But the asset itself is creating nothing.
Second key point, the lack of intrinsic value. Warren Buffett's central critique of Bitcoin revolves around its absence of intrinsic value, a preference rooted in his enduring faith in tangible investments. He contrasts investing in productive assets such as stocks, real estate, or businesses that generate income, and investing in non-productive assets like Bitcoin. Productive assets offer tangible value in dividends, rent, or profits, while Bitcoin, according to Buffett, cannot produce anything of substance. Buffett drives home this point by drawing a parallel with buying farmland. When you own farmland, you can assess the crops it yields and the income it generates, providing a concrete basis for evaluating its value. In contrast, owning Bitcoin hinges solely on the hope that someone else will be willing to pay a higher price for it in the future. Buffett emphasizes that such an investment relies on the greater fool theory, where you depend on someone else being more enthusiastic about Bitcoin than you are. Furthermore, Buffett invokes historical examples to underline his argument, such as the tulip mania in the 17th century, where people speculated on the price of tulip bulbs or the comparatively modest long-term returns of gold when measured against productive assets. Warren Buffett's investment philosophy consistently gravitates toward businesses and assets with tangible value and a track record of generating goods or services. His portfolio typically includes shares in well-established companies possessing competitive advantages and demonstrating long-term growth potential. This preference for tangible investments is closely intertwined with his belief that Bitcoin falls short in terms of being a dependable vehicle for building wealth. Buffett's stance reflects his conviction that reliable investments should have intrinsic worth, the capacity to generate income, and a demonstrated history of providing value to investors. In his view, these characteristics are essential components of a sound and sustainable investment, qualities he perceives as conspicuously absent in the case of Bitcoin due to its intangible nature and speculative tendencies. This preference for tangible assets aligns seamlessly with his overarching approach to wealth creation and investment strategies. For those considering cryptocurrency investments, Warren Buffett's insights offer valuable perspectives. While he expresses skepticism about cryptocurrencies as a long-term investment, his approach, rooted in intrinsic value and productive capabilities principles, provides a solid foundation for making informed decisions. The cryptocurrency realm is dynamic and polarizing, and Buffett's viewpoint encourages prudence and critical thinking. Whether you agree or oppose his stance, his input contributes to the ongoing discourse about the role of digital assets in the financial arena. Warren Buffett's opinions on Bitcoin have generated extensive discussions within the financial world. While he also acknowledges the innovation of blockchain, he remains steadfast in his belief that cryptocurrencies like Bitcoin lack the fundamental characteristics of productive assets. Ultimately, your journey in finance is unique, and your decisions should align with your goals and risk tolerance. Remember that informed, well-researched choices are key in this diverse financial landscape, where opportunities abound for those who approach it with care and consideration. Thank you for watching. Don't forget to like this video, subscribe to my channel, and ring that notification bell for more updates. Happy investing!